the global economy, we're still in a situation where we've got weakness not only in Europe, but increasingly in Asia and China. Secondly, the cumulative weak growth phase is now feeding through into subdued inflation, not only in the US, but elsewhere around the world. And I think against that kind of environment, what we're talking about is the Fed taking their foot a little bit off the accelerator. So they're talking about tapering, but not ending QE3. And I think, that does sort of suggest that the Fed will remain the buyer of choice, and that will sort of cap any significant spike higher in yields.
But even just the mere mention of tapering, even if it is several months in advance, we've seen what impact that has had on the bond market.
Absolutely, and I think, as I said, in the short term, you have to go with that, and that's going to dominate. We've got obviously the payroll figures next week, which the market's attaching added importance to. And then all the way through June, I think the market is going to be very sensitive running up to the press conference at the next FOMC meeting. But if we look out, multi-year, I think that there's just too many sort of global uncertainties to suggest that we're seeing the beginning of a major bear market.
Selling has been done on very, very strong volumes. Last week, almost 10 million contracts on the Treasury futures traded. That was the highest in many years. What's that telling us?
I think that's telling us that there's a lot of portfolio managers out there that are hedging. They're long cash, they're selling the futures just to sort of hedge exposure. And I think there's a degree of apprehension that they need to lock in profits after a very good multi-year rally. So I think that's what it's sort of telling you, and I think that's what the price action in terms of the sharp rise in 10-year yields that's been seen through the course of May.